Hi, this is Wes Moss with an outlook for the year ahead. The world is changing, and I want to share 7 themes that are critically important to markets and the economy and investors in the year ahead. And I want you to be honest with yourself when I ask you this question. This is the way I want to start today, is that if I had gone back, and let's go back 2 years, if I had gone back and told you as an investor and said, what do you think the stock market would have done if I had told you in the next couple of weeks, the United States and the world would get hit by a global pandemic that would take the lives of over 5 million people, shut down the United States for a 2-month period of time, take over 800,000 lives in the United States, and then at the end of a 2-year period, the pandemic wouldn't have fizzled out, but it would actually be at an all-time high when it comes to case counts. What would you have thought the market would have done during that period of time? Now be honest with yourself. Armed with that information, you would have said down, maybe down a lot. Very scary news about to hit the world starting just 2 years ago. As we all know, COVID. And here we are in a new year, 2022, and COVID cases are higher than they've ever been, and by a long shot. However, over this last 2-year period, and it almost feels like we've had a 2-year year, because the entire 2 years it's been dominated by this theme, which is COVID-1, COVID-2, COVID-3, shutdowns, reopenings, threat of shutdowns, reopenings. And here we are 2 years later. And the S&P 500, which is the broadest measure that we can look at for the US stock market, is up a little over 50%. So not flat, not down, but up over 50% over that 2-year period of time. So investors that have stayed the course and have weathered the storm and stayed invested in large part have been rewarded over the last couple of years, despite all of the scary headlines and all the things that we've all had to live through. What's also fascinating is just the sheer dichotomy between all of the economic numbers and how Americans are actually feeling from a sentiment perspective. Think about the economic numbers. Stock market up over 25%. Unemployment rate has gone from almost 14% down to around 4%. Americans are wealthier than they've ever been, with household net worth reaching over $140 trillion in the United States, which is an all-time high. And we saw US GDP grow more than 5% in 2021. But on the other side of the spectrum, the complete other side of the spectrum, U.S. consumer sentiment, measured by University of Michigan Consumer Sentiment Index, is so low that you have to go all the way back to the depths of the great financial crisis to match how Americans are feeling. University of Michigan Consumer Sentiment measures how Americans feel about the future of the economy, their own personal finances, how they think businesses are doing, and what kind of confidence they have in making new purchases or buying decisions. Really an outlook into how people are feeling in the U.S. In fact, as we start 2022, U.S. consumer sentiment is lower than where we were in March and April of 2000, when the world was almost completely shut down for what was then a brand new, very scary pandemic. The question is, why is there such a disconnect between great economic numbers and America's just not feeling all that great? And the answer is what I think is a very large part of the outlook for 2022. And that is the impact of how COVID is making Americans feel. First of all, we were supposed to be out of this a long time ago. And not only are we not out of COVID, starting in early November, we saw this massive surge of Omicron. And going into the holiday season, we saw millions of Americans, arguably per day, get back a positive COVID test. Moss family included. Me, Lynn, all the kids, all throughout the Christmas holiday. So the COVID domino effect has just continued to wear on and on and on. And the reality here is that not only has COVID been this health crisis in the United States, it's also been a massive wet blanket on just our freedoms and our way of life and the unbridledness that we're so used to in the United States. Have to think about COVID before you go to a family gathering. Have to think about COVID if you want to leave the country. Have to think about COVID if you want to get back into the country. Have to think about COVID when it comes to school, in person or virtual, like a lot of parents are having to deal with again in the beginning of 2022. The reality of trying to go get a COVID test. wait for a COVID test, mandates for millions of Americans to get a vaccine, mandates to wear masks, quarantining, all the supply chain issues that have led to grocery stores being half empty and your favorite restaurants not being open. We've dealt with this for 2 years now. And instead of going away, 2 years into a pandemic, COVID is still headline number 1, 2, and 3. We're just tired of it. You're tired of it. We're tired of it. Any rational human is tired of it. And that, of course, is the reason, at least as far as we can tell, why there's such a disconnect between great economic numbers, good news for the economy, good news for investors, and Americans still dealing with this persistent issue now going into its 3rd year. So we have great economic data, but people don't feel all that great in the United States. Which brings us to 2022, where I see a lot of good news happening, a lot of tailwinds for this economy and our way of life versus the many headwinds we faced over the last 2. So the world's changing. There's 7 really key themes for investors over the next year. I'm going to start with number 1, which has to do with the elephant in the room, which is today, Omicron, but really just a continuation of the same story we've seen for the last 2, which is COVID-1, COVID-2, now COVID-3. We all know that we've been in a pandemic, but now we may be going, particularly in this upcoming year, into the next phase of this, which is the endemic phase. Now, there's no perfect answer to know exactly when any sort of health crisis or virus shifts from a pandemic into an endemic, but we know that 2 years into this, we're a lot closer to this next phase, the endemic phase, than we were to start with. We've already seen this rapid spread of Omicron around the world and in the United States. But we've also seen what seems to be less severe disease, less people having to go to the hospital, less mortalities. If that trend continues, more widespread but less severe, then we get closer and closer to this true herd immunity in the United States, helped by those who've already had prior infection, helped by the nearly 500 million vaccine doses that have been administered, 500 million doses just in the United States. And we get to a point where mentally, we get closer and closer to stop having to think about COVID in every single walk of life. What does COVID do to the economy? What does COVID do to the family? What does the COVID do to me, my wife, my kids, politics, you name it? We're getting closer and closer to that phase. And 2022, we think is a year where we really move from pandemic to endemic. And even though there may be no perfect timing on that, it's really a mindset shift from thinking about how do we not get COVID to like any other risk that we face every single day, which is something that just needs to be managed and is a part of life. Once we move into that phase, it impacts all of our decision making. And we can start to see consumer sentiment go back higher, which is an important tailwind for US consumers and the US economy. Number 2 on the list, less government stimulus, but stimulus nonetheless. We have seen unprecedented stimulus over the last several years, almost $6 trillion from Washington, D.C., increasing the money supply, spending money to try to help the economy get through COVID. 10% of GDP, 11% of GDP worth of just brand new stimulus. Now that has helped lead to a lot of the strong economic numbers and the strong stock market that we've seen. We saw money supply jump almost 40% in the United States over the past 2 years. It's also created inflation, which we'll get to in a minute, but it's been a massive jet stream to help this economy recover. The stimulus is going to be a lot less in the coming year, but it doesn't mean we're not going to have stimulus. We'll still see between 2 and 3% stimulus coming out of Washington that will continue to help boost the US economy. So instead of seeing GDP growth that was north of 5% in 2021, we'll likely see GDP growth closer to 3%, still strong, in 2022. Speaking of GDP, number 3 on the list, we just talked about how we think GDP will be closer to the 2.5% to 3% range. Another really important measure when it comes to watching where GDP is headed is something called leading economic indicators, or LEI, that is closely watched by the Fed. If we're pinpointing where LEI is today, it's close to the 10% level, which means it's a very long way away from the zero bound. The zero bound is when we start to get worried about recessions or negative GDP growth. So where LEI is today, it typically suggests that we're not just months away from a recession, but typically years away from having to worry about a recession, which of course means negative GDP growth. Another tailwind for 2022. Number 4, corporate earnings. We went through in 2020 this almost shockwave of earnings where earnings got crushed because the economy was shut down, and then this massive rebound, again, a shockwave for earnings in 2021 to get back to today where we are in early 2022. So even though in 2022 we don't see 20 or 30% earnings growth, we still will likely be in the 8 to 10% range, which is historically still very strong for markets. To give you some reference, back in 2019, pre-pandemic, S&P 500 earned about $165 a share collectively. Estimates for 2022, close to $230 per share for the S&P 500. Which brings us to number 5, inflation. If there was anything that competed for headline number 1, particularly on the economic side, over the past at least year, it's certainly been inflation and the worry about higher prices. We've seen inflation this past year that is a la the 1970s. And it's not just little things in the grocery store, it's massive parts of our budget as Americans. Housing prices up 20, 30, 40% depending on where or what state you're in. New car prices up 10 to 15%. Used car prices up 20 to 40%. Overall inflation rivaled only by the 1970s. Now the good news is a lot of the supply chain issues are already starting to correct. We already talked about lower levels of government stimulus, which means it's very unlikely for the US money supply to keep expanding, which should start to really moderate inflation. So at some point, inflation can be very much self-correcting. Imagine if used car prices continue at another 30 or 35% pace, you could see used Toyota Corollas selling for $50,000, which makes no sense. So we have to see some moderation when it comes to inflation. Again, another tailwind in 2022. Which brings me to the Fed. The Federal Reserve, who's really helped navigate this economy through the last couple of years, but almost became a punchline in 2021 as they insisted that inflation was transitory. Oh, it's only going to last a month, 3 months, no, 6 months, then a year, and here we are with inflation, which we think will eventually moderate, but the thought of transitory was months, not years. And the Fed knows that they've kind of missed the boat when it comes to inflation. So what are the tools in their toolkit to help moderate what's now become economic problem number 1? Very simply, they've got to tap the brakes. That means the Federal Reserve will start raising interest rates, making the cost of money in the United States more expensive. And even though we all love low interest rates for car loans, low interest rates for housing, getting interest rates off the zero bound where they've been now for several years is actually healthy for a lot of different parts of the economy. Think banks, financial institutions, insurance companies. All these companies will actually thrive with slightly higher interest rates after living through an economic period of time with almost zero interest rates. It's also a reward for savers in the United States that have been forced to collect 1 or 2% on CDs as rates go up. It'll also benefit millions of Americans that have been sitting on cash earning virtually nothing. So even though we see the Federal Reserve tapping the brakes, those higher interest rates may actually be a net positive and yet another tailwind in 2022. Which brings us to number 7, politics. 2022 is a midterm election year, and I'm not going to sit here and forecast who's going to win the House, the Senate, but if you go back in history and look at midterm election years, the pattern is very clear and very strong. First of all, midterm election years average a little over 9% per year historically. That's a tailwind. But there's a little bit of a cap on how stocks do going into the fall. And then as soon as the market starts to understand who's going to win the election or who finally does win in early November, stocks typically take off and end the year very strong. So midterm election year, another tailwind for stocks in 2022. Of course, we all know it's very difficult to forecast what's going to happen economically and stock market wise in any given year. But if you look at the totality of the economic data and you look at where we have been, and we've gotten this far in an economy and this far in a market, and the consumer sentiment that we started with here today has been not all that great. Imagine as this world continues to change and some of these themes start to play out in 2022, and the pandemic shifts from a pandemic to closer to an endemic. We have strong GDP growth, strong earnings growth, moderating inflation, and then some political certainty towards the end of 2022. That's a lot more from the tailwind category than the headwind category that we've been facing. Put it all together, and it's a pretty good environment for this economy and for the markets. Will it play out exactly how we just laid out? Probably not. But on balance, I'm very optimistic about 2022. Thanks so much for tuning in.